Today we are taking a deep breath and plunging into a pretty high-stakes investment report.
A really high-octane one.
Yeah, that's the word for it. It's centered on Applied Digital Core, ticker APLD. And the report, it doesn't mince words.
Not at all. It flat out calls this a high-volatility AI buy-the-dip opportunity.
And that framing, I mean, it tells you everything, right? It's why we're here. APLD is moving fast.
Exactly. And there's a real debate happening. Is this big price move a major liftoff or, just another head fake?
That's the core question the analysis is asking. Is this the perfect time to get in before the next big leg up?
It's a huge question.
And what's so interesting is that the report describes APLD as a kind of sleeping giant finally waking up. It says there are all these major catalysts just converging at the same time. It's an infrastructure company, but it's moving like a tech startup.
And to set the stage for anyone who's maybe new to this story, we should probably define what APLD actually does.
Good point.
They're essentially the landlord for AI infrastructure. So they don't make the chips, they're not NVIDIA, they don't build the software models.
They build the houses for the chips.
That's a perfect way to put it. They design and operate these massive data centers that are needed to house all that powerful equipment.
So they're providing the real estate, the power, the cooling, all the critical stuff that makes AI actually work.
Precisely. They control the physical means of AI production.
Okay, so let's get into the urgency here, the thing that triggered this analysis in the first place. The price action.
Right. This is what made everyone sit up and pay attention. We're looking at Friday, January 2nd.
What happened?
The stock closed at $28.11. That's a jump of 14.64% in a single day.
Wow. Okay, a nearly 15% move is huge, but it's the who behind it that the report focuses on, isn't it?
Exactly, the volume. The report highlights this massive uptick, 36 million shares traded.
And their average is what, about 23 million?
Yeah, just 23 million. So that extra volume, combined with the price spike, is being read as strong, clear, institutional buying.
So not just a bunch of day traders. This is big money.
Big money moving in. And what's fascinating is how that looks on a chart. The analysis is very clear that APLD has broken out of what's called a consolidation phase.
Okay, so for those of us who aren't, staring at charts all day, what does consolidation actually mean in plain English?
Think of it like a coiled spring. It's a period where the stock price just trades sideways.
Right.
The buyers and sellers are sort of in a deadlock, and the pressure is just building. That 14% jump on huge volume suggests the buyers finally won that fight.
And now the stock is, what did the report say? Knocking on the door of $30.
That's the one. And $30 is a huge psychological and technical level to break.
And if it does break that level?
According to the analysis, if it clears $30 and holds it, the road to $40 looks wide open.
So it could signal the start of a whole new aggressive uptrend.
That's the technical case, purely based on momentum in this breakout.
But wait, whenever I see a big jump like that, I always wonder if it's just short sellers getting squeezed. Does the report address that?
That's a great question. And it sort of does, implicitly. It frames this buying not as a reaction, but as a precursor.
The precursor to what?
To the huge near-term catalyst, an event that's just days away.
Ah, so this is why the timing is so critical.
Perfectly timed.
Yeah.
It all comes down to one date. Wednesday, January 7th.
And that is?
That's when Applied Digital reports earnings. It's the moment of truth.
And expectations have to be sky high given the whole AI boom.
They're massive. I mean, look at their last quarter. The report notes they had 84% year-over-year growth. 84%.
So investors are betting that kind of explosive growth is going to continue.
Absolutely. And that's where last Friday's price action makes sense. The analysis calls it a classic smart money play.
Meaning?
Stocks often run up into an earnings report if the big players are confident. So that spike is seen as smart money getting positioned before the numbers actually drop.
They're placing their bets.
They are. They're betting on a positive outcome.
So on Wednesday, what's the one thing that could actually confirm those bets and cause a real gap up in the stock price?
The report is very specific here. The real trigger isn't just revenue. It's confirmation that their existing massive backlog of contracts is turning into actual cash.
So it's not enough to sign the deals. They have to show they're collecting the rent checks.
You got it. If they can show those data centers are being built fast and are generating cash now, the market will react very, very aggressively.
Okay, that covers the short-term trade, the earnings play. But the report says APLD's story goes much deeper, right?
Oh, much deeper. This is where we move from the quick trade to the long-term structural catalysts, the things that could make this a real compounder.
And the biggest one seems to be this plan for a spin-off.
The Chronoscale spin-off. The analysis calls it the hidden gem. It's the plan to spin off APLD's cloud business into a totally new separate company.
Okay, help me understand this. Why does taking one company and making it two suddenly increase the value?
It's a classic Wall Street move to eliminate what's called a conglomerate discount.
A conglomerate discount.
Yeah. Right now, you have one company doing two very different things. One side is building data centers, which is super capital intensive.
Right, like construction.
And the other side, Chronoscale, is a high-margin cloud services business. Investors get confused. They don't know if they're buying a construction company or a tech company, so they discount the whole thing.
So by spinning it off, you're unbundling them. You get two pure play companies.
Exactly. APLD stays the infrastructure builder with predictable cash flow. And Chronoscale becomes a pure play AI cloud company, which could get a much higher valuation, based on tech growth rates.
But the report says this deal isn't closing until the first half of 2026. That's a ways off. Why would the market care now?
Because markets are forward-looking. If big investors see a clear path to unlocking value in 2 years, they start buying now to get ahead of it.
I see. But that still doesn't solve the immediate problem. Building all those data centers must be burning a massive amount of cash.
It is. And that's the key counter-argument that the report have to address.
So how does a company that is, right now, losing money justify spending all this capital?
It comes down to something the report calls the AI Gold Vault.
The AI Gold Vault. Tell me more.
It's their contractual safety net. The analysis points to their massive, already signed backlog. We're talking $16 billion in expected revenue from leases over the next 15 years.
$16 billion, and that's already on the books.
These are signed commitments. So that huge guaranteed backlog acts like collateral. It ensures that all the money they're spending now to build this stuff will get paid back.
Ah, so the negative profit today isn't a business failing. It's the cost of building a future utility.
You've nailed it. It's like building a railroad. You spend a ton of money up front, and once it's built, the cash just flows for decades.
Okay, this is all starting to come together. We've got the technicals, the earnings catalyst, the long-term spin-off. Let's talk numbers. Let's balance the risk and reward.
Right. Let's start with the bullish forecast. This is the high-octane part. Analysts are projecting a really dramatic growth curve.
How dramatic?
They're forecasting that revenue will nearly double in just 1 year, from about $297 million in 2025 to over $552 million in 2026.
That's a huge ramp up.
It is. And that trajectory is why you see some really aggressive analyst price targets.
What?
The report cites firms like Needham. Their targets are between $40 and $58 a share.
And the stock just closed at $28, so that's a potential upside of, 40% to over 100%?
That's right. And that is why there's such a rush to get in, that potential return.
And there's always a but. The title of the analysis says high volatility. What are the risks?
This is critical. The report stresses, and we have to reiterate, APLD is not profitable yet.
Right. Their earnings per share, their EPS is negative.
It is. And we've talked about why they're spending every dime they have to build as fast as possible, but you are absolutely betting on future success. If there are any delays, any cost overruns,
The market will punish them.
hard. And that leads to the second big risk factor, the volatility itself.
We started by talking about a 15% jump in one day.
And the report says a move like that, up or down, is normal here. This is not a stock for the faint of heart. You have to be okay with potentially violent swings.
So we have this perfect storm. Short-term pressure from earnings, long-term value from the spinoff, but all set against this backdrop of high risk and no current profits.
That's the setup.
So what's the final verdict from the analysis report is now the time.
The verdict is very clear. APLD is not a safe dividend stock. It's a high-risk, high-reward play.
But the signal is a buy, right? For a certain type of investor.
Yes. The report flashes a buy signal for anyone looking for that high-octane growth who believes the whole AI infrastructure build-out is really just getting started.
And it comes back to that urgency, the idea that the window might be closing.
It does. The report really hammers that home.
Yeah.
Because of the chart breakout and the earnings coming on Wednesday, it says the window to get in under $30 might be closing fast.
Which puts the decision squarely on you, the listener, right now.
It really does. And the final thought to leave people with is this. You have to weigh the long-term value, that Chronoscale spinoff, the $16 billion backlog against the current cost. And that cost is negative profits and high volatility. So the question becomes, do you trust the institutional money and the chart breakout and ride that momentum into earnings? Or is the smarter play to wait for a potential dip after the report, which can happen even on good news, and manage your risk that way? That's the decision on the table.